Okay. I trust you can see the screen today. So I want to apologize. The last class, embarrassingly, I didn't have the screen share on, so you couldn't see the screen. So when I recorded it, you just heard me talking. So this is what I'm going to do. So what I basically did was I had recapped a little bit from the prior class. I had kind of recapped where we were up to this point. You don't have to hear that again. What I want to do though is just to kind of check the box here. I want to go through the core of the debt schedule again so you can visualize it. I think it's important. I'm not going to go through the whole class doing it. I'm going to go through it quickly and then move on to the next steps. But the real goal of this class is to try to complete the model. Right? We're very close. And then what I want to talk about, then we make a major shift from modeling to valuation. And I want to talk to you guys about how I should do this going forward. Originally, this was meant to be live. I couldn't figure out what time to do it live. We had a bunch of participants, and then over time, those participants dropped off and are watching them when I post them on YouTube. So should I just post them on YouTube? I want to kind of get your guys' feedback on what the best format is to do this until we open our school back up fully, downtown. But anyway, so the purpose of the debt schedule, now that you can see it, maintains cash debt balances and the interest expense and interest income that's associated with that. So as you know, the final piece, what I walked through, which is important to visualize, if you look at our statements, we're pretty much all there except for this interest expense, interest income, which is a major component to our EPS, right? We also don't have our cash flow from financing activities. This is debt related. And our balance sheet debt balances, they don't move. They're not moving because although they are already linked in from the cash flow statement, they're linked in from empty spaces in the cash flow statement. So the debt schedule, I think about it almost like a keystone in a pyramid, where once you get this debt schedule linked up, it impacts all the statements. So that's the importance of it. So just to go over what the structure is, at the top here, we maintain our measure of cash that we have. Then we have debts, and the debts are determined by what we've laid out in our cash flow statement and our balance sheet. And I've identified 4 major pieces of debts. Now, okay, short-term debt is 0 here because they don't really show short-term debt on their balance sheet, which I thought was unusual. I mean, I'm sure they have short-term debt. They just lumped it in somewhere else. And actually, in the 2020 financials, they do show short-term debt. So I'm glad I put this in as a placeholder. They have long-term debt. They have leases, long-term debt leases, and then they have this long-term financing obligations, which is another category of leases for them. These are capital leases, not operating leases. I'm not going to go into capital and operating leases in this course, but a capital lease is basically ends up with ownership of the property. And because it ends up with ownership of the property, it is balance sheet related. It does incur interest. And because it's balance sheet related, I will put it on the debt schedule. So we can talk more about that, or you can look in my books about more about that. So the core structure of the statements is as follows. And what I'm going to do, I'm not going to spend too much time, but I'm going to delete, hold on, just so you can kind of follow with me, because I think it's important. I'm going to delete, yes.
Well, I see your PowerPoint, not the Excel sheet.
Okay. Boy, I'm really losing it now. So when I click on the Excel sheet, Lloyd, so here's the PowerPoint. When I click on I'm sharing my whole screen. Is it just slow for you? Maybe? Is there a
No, it's just the PowerPoint. I see debt schedule on 38.
Okay, hang on now. Boom. Okay, you're right. My mistake. Here we go. I don't know why. I feel like I'm losing it this week and last week. Now you should see Excel.
I do. Thank you.
All right, good. So what I want to do now, good. So right before I start moving forward, what I want to do is I want to just delete all these things and go through it a little bit faster than last time, so we can make room for new stuff. Yep. So let me just delete this to show where we were at. Might not be necessary to delete everything, but I'll show you actually a quick trick. So for those that have followed me in the last course and think this is redundant, I'm going to show you a couple tricks to get through the debt schedule faster as well. And there's also, if you noticed, if you look up on my YouTube channel, debt schedule, I do a full hour-and-a-half course diving real deep into debt schedules if you want more information. Okay, so starting point is pulling in the ending year reported balances from 2019. That's the starting point. Ending year reported balances of the respective debts, ending year reported balances of cash. So short-term debt was pulled in, the short-term debt at the end of the year was pulled in from the ending reported short-term debt 2019. Okay. Long-term debt end of the year was pulled in from the long-term debt 2019. Okay. And so on. Same thing with long-term lease liabilities, long-term debt obligations, and then cash at the end of the year was pulled in from the last reported cash balance from the debt from the balance sheet. Okay, so this is our starting point, because the point is we want to build everything not by pulling the future years from the balance sheet. We want to build everything once again from the last reported balances here. Okay. And so the way the schedule is laid out, we start with analyzing cash, then we analyze the respective debts. And so I want to start by analyzing cash by taking the cash at the beginning of the year, and the cash 2020 at the beginning of the year is going to be equal to 2019 cash at the end of the year from the year before. This is our running balance. So all our cash and debts are going to work this way, where you have the beginning of the year is going to pull in from the last year's year end. We're going to copy this to the right. It's going to show 0 going forward. But now we have cash flow before debt pay down, which is something that we've calculated on the cash flow statement. I'm going to just pull it in quickly. This is the cash flow before debt pay down, and let's talk about it. Pull it in, copy to the right. What we're trying to get here is a measure of cash that we can freely use to possibly pay down or reconstruct our debts. And so we want to know, first of all, how much cash do I have freely? I start with the cash that I started with at the beginning of the year, which is the cash from the year before. Then I start with how much cash I've generated this year, not including cash from debt paydowns. Otherwise, that would be redundant. Let me jump over here. Right? These line items, and this is what I was trying to show last class that you couldn't see. If I, for example, decide to pay down $30 million in debts, right? My cash should be this is billions, right? My cash should be $12 billion, the cash generated. But I want to know, for purposes of the debt schedule, how much cash do I have before paying any debts down? That's the 42 billion, right? Because my purpose of the debt schedule is to determine whether this $30 million pay down is accurate or is important to me. So I want a measure of cash before all of these line items have been taken into account. So that's why this number is a sum of everything excluding those line items, okay? Now, when I delete this, these numbers look the same because I haven't linked this fully in. But the idea is the cash flow before that pay down is a little bit different. It's stripped of those line items. And then I want a minimum cash cushion. The minimum cash cushion, I estimate it to be 30 billion. And I'll show you how I do this. This is cash I don't want to touch. So really what I want a measure of for purposes of the debt schedule, and I'm going to sum everything above using an alt equals. What I want is how much cash can I touch to pay down debts if I choose to manage my debt schedule this way? Well, I got my 36 billion. I got my 42 that I generated. I don't want to touch 30 billion. I want 30 billion to always be on my balance sheet for emergency purposes. So I can pay down technically 48 billion if I wanted to. That's the cash available to pay down debt. I want to make sure these have meaning to you instead of just memorizing them. So let's look at the minimum cash cushion. I just kind of eyeballed this. Right now, this is climbing very dramatically. This will change as we pay down debts. But if you go back about 5 years, they really don't dip below 30 billion. So I'm going to estimate that that's the cushion for these guys. And companies don't really talk about what their minimum cash cushion is. You can kind of just get a sense for, how low they can dip in their cash balance. And so when you copy these to the right, you get an idea of how much cash we can utilize, although this number is going to change as we populate going forward. This is a running balance of cash. Okay. And then we do the same thing for debts. We build running debt balances, and I'll show you a trick here. But first, before I show you the trick, let me just go through how it's normally set up. We have short-term debt at the beginning of the year equals the short-term debt from the year before. Okay, that we can copy to the right, a running balance. Then we have these issuances and retirements. I explained the nature of issuances and retirements. An issuance is raising debt, and a retirement is paying down debt. So if you want to raise debt, you put a positive number in here. I raised $10 billion. If you want to pay down debt, I'm going to put a negative value in there, negative $10 billion. Why? Because what happens is, and let me leave that in there just for example, short-term debt at the end of the year is a sum of everything above. It's the debt we started with, plus all the issuances or retirements. So if I were to pay down debt, put down negative 10 billion, I'm going to end up with negative 10 billion in debt. Now, it doesn't make sense. You can't have negative debt. But if I were to raise debt and put in 5 billion or 50 billion, I'm going to have 50 billion in debt. That's the point. That's how the debt schedule works. And what we really want to have happen here is we want, as these debts raise or decrease, the interest expense adjusts with it and then flows into the income statement and continues to link through the rest of the model. That's the point. That's the major purpose, right? So it's tough to see here when our short-term debt doesn't exist. But the reason why we have issuances and retirements in two line items is really a technical modeling issue. It's not an accounting issue. Both these line items combined mean the same thing. A positive number is a debt issuance, a debt raise, a negative number is paying it down. But oftentimes when you raise debt, and I used the example last week of thinking about a mortgage, if you were to take out a mortgage on a house, all of a sudden you have principal debt payments. You have to pay $500 a month, right? You have to pay down the balance. That is a mandatory retirement. You are required by contract to pay $500 a month, 500, 500, 500. Now, what happens if one year you get a big bonus and you say, you know what, I'm going to use that bonus to pay down my mortgage a little bit. So that's the non-mandatory issuance or retirements. The non-mandatory is what you can pay down above and beyond what's contracted. And the reason why in modeling we separate that is because there's a pretty cool automatic formula we utilize for non-mandatory issuances. There's a lot of algorithms we can throw in there to automate your non-mandatory issuances based on certain cash hurdles we will talk about. But also, I don't want to interfere with what I know is contracted. So if I were a modeler and I came in here and I said, well, I'm going to pay down a little bit more this year, I don't want to interfere. If I want to undo that scenario, then I got to go back to the debt contracts, look up what was that going on in that year, or it's just easier to have it separated. And so, and also when we start getting into formulas here, we don't interfere with what's being contracted. So I'm going to copy this here. And then I'm going to create my interest expense. And as I spoke about in the last class, we take an average. Why do we take an average? Well, if I were to raise $1 billion, right, my interest on that is going to be $1 billion times 3, 30 million. Now, it's truly 30 million depending on when I raise that debt. If I raise that debt in January, the beginning of the year, yeah, that's $30 million. It's a full year of interest. What if I raise that debt in December at the end of the year? I wouldn't have had 30 million. I would have had maybe 31 days of 30 million. 31 divided by 360 times 30. So how do I break that into more detail? Well, one way to do it is to build a monthly model, which if you really want to analyze your debts, you might want to go into that direction. But what we do for simplicity is we average the beginning and end of the year. We take an average. And the average assumes that there is some prorating going on with the interest expense if we happen to raise or pay down during the year. So instead of it being straight up 1 billion times 30, it's going to be an average, AVR, AG, open parenthesis. Beginning of year, I like to take beginning of the year from here. It just makes it a little bit cleaner. You could take it from up there if you'd like. Comma, here, end of year, times 3%. Now it's cut in half. And I know that might not be completely accurate, but it adjusts for time. And now going forward, it's going to jump to 30 because now it's been on there for a full year. And then when I zero this out, that'll go to 0 because this is nicely fully automated. Okay. Now my trick. The formula is the exact same for all debts. This is the same. 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 The average form is the same. So what I'm going to do is I'm going to copy this whole block. I didn't do this in the last class. Take this whole block. I'm going to Control C. What I recommend for you guys, if you're a little rusty, is to practice building out the long-term debt and the other debts as I had just done the short-term debt. But here's a trick. Copy, move your arrow key to the top of the long-term debt, Control V. Same formula. Go down to the long-term lease liabilities, Control V. Go down to finance activities, Control V. In our full class, when we were down at the on Wall Street, I gave you guys tests, speedy modeling tests. This is a great way. Building out this debt schedule will take a whole class. I just shortened it for you. So this is where we have all our debts built out. And then at the bottom, this is where we now start to total up some line items from above. That's what's going to be utilized to link in through our statements. I want a sum of all the issuances. I want to know in total how much debt this year has been raised or how much has been paid down. So I'm going to sum up each issuance and retirement for each debt. So there's 2 for each debt. There's mandatory, non-mandatory for the short term, mandatory, non-mandatory for long term, mandatory, non-mandatory for long-term leases, mandatory, non-mandatory for long-term financing obligations. So they look like there's 0 now. Oops, look at this. I missed one. I could swear. Okay, so I'm going to go in there. G26, G27 plus G28. There we go. Copy to the right. Double check my work here. I'm losing it. Okay. Next, total interest expense. I want a sum of all the interest. So we got 0 for short-term debt. We got this 1170 for long-term. We got this long-term lease liability. We got financing. 1, 2, 3, 4, 3160. Okay. It's all the interest. Okay. Then we have cash at the end of the year. Now, this is tricky. I know a lot of times you guys memorize this as analysts. I know a lot of times you guys, it's tough to memorize, and sometimes you get it. Oftentimes in the modeling tests I would give, you would get it wrong. My recommendation is to conceptualize what's going on here. And so the concept is, I want a measure of cash at the end of the year. Guess what? We have this number on the balance sheet, 78503.4, but I don't want to link that in. Don't make that mistake. I've seen a lot of people link that in. Not correct. Your model won't flow properly. I want to calculate that. I want to get to that number by calculating top down. And so I want to think about, well, what's my measure of cash? How do I get an impression of all the cash that I've generated this year just by using items from the debt schedule? Well, I first start with the cash at the beginning of the year. This is the cash I started with, 36 billion. And then I have cash flow before debt paydown. This is the cash that I generated during 2020. This is the cash I made, but guess what? Does not include my debt paydown. So what am I missing here? What I'm missing here is the cash generated from the debt pay down. Right? Think about a timeline. First, I have cash January 1st. Then I have all the cash from January 1st to December 31st. But that's missing all the issuances and retirements that would be projected here. Now there's zero now, but if they had value, it would complete my measure of cash. So my cash at the end of the year is cash at the beginning of the year plus cash flow before that pay down plus the total issuances and retirements. 78503.4. My match says yes, meaning it does tie with 78503.4 here. Now the real test is once the whole model is linked through and I am actively raising and paying down debts, does it still match? Oftentimes it doesn't. And this is where the complexity comes in. This means either your cash at the end of the year formula is wrong or you're linking things through incorrectly. So now that you have cash at the end of the year, you can calculate interest income. If you look on your income statement, we have interest expense and we have interest income. Interest income is basically income generated from your cash sitting in your bank account, maybe investing in money market funds, the little 1%. And I believe I looked it up on the 10K. We could do it together. They said that on average they received a 1.3% interest income rate. Before we go into detail on that, let's calculate it. And you calculate it in much the same way that you calculate interest expense. It's the average, open parentheses, last year's, this year's, times the rate. Okay, 573, copy to the right. So what I'd like to do, this is it. This is the debt schedule. What needs to be done in terms of utilizing the debt schedule is honing in on the interest rates better, honing in on the income rates better. And there's several ways to get that information. Okay. One is the 10K. And I don't want to spend too much time digging, but I want to show you how to get there. So here's the 2019 10K. And also really because, guys, after this, once we're done with the model, I'm going to present to you the updated 2020 model. So the numbers are going to change. But first, you can always do some word searching. I'm going to go interest, income. Okay. Where they talk a little bit about how they invest in it. And there is a table. There is a table. Okay. Let me just do interest. There is a table where they talk about, there we go. Effective interest rates. Nope, that's debt. They talked about income. This is debt interest. It's pretty low. We'll talk about that when we update the model. I'm not gonna spend too much time. Okay, I'm missing it. But if you dig in here, what I'll show you is I have our final model here where I had it in there. They had specifically said 1.7. Here we go. Perfect. Page 32 of the 10K. Okay, so on 32 of the 10K, they say, oops, I must have went way past it, just so I can show you. It looks like it was 1.7. Okay, here we go. So I had it there. I must have skipped right over it. So money market funds, this is where they're investing their money. And there's a note at the bottom. I thought there's a note here where they explain. Okay. So this is what I had done. I had taken a weighted average. Here we go. I took a weighted average. Okay, it was 1.71. What I did was I had taken, these are all the places that they're investing their cash in. I took 18,850 times 1.09% plus 11,829 times 241 plus 702 times 177 and so on, divided by 45297. That gave me an average weighted of 1.71%. So this is basic math. I'm just gonna paste this in so you have it in your template. I'm not gonna spend the time to go through it together, but there we go. Okay, and it's noted where it came from. Okay. So I took the weighted average. In the Walmart book, and I'm going to get into more detail in the Amazon book that I'm going to write. I went into detail about how to dig up these interest rates. I don't want to spend time doing research. I want to just focus on the modeling here. Okay. So, more importantly, what I'd like to do now, hang on. Let me make sure I pasted this in the right place. What I'd like to do is show you how this all links through. Okay. There we go. Let me open this up. All right. Good time to my mouth to freeze while this is trying to figure itself out. So the first thing I want to do is go to the interest expense and interest income. Okay, we want to link these into the interest expense and interest income. My model's deciding to crash. Great. Okay, we're back. I paused the recording so you don't have to. So what I had done was I'm just increasing the decimal places to 2, and I'm copying this to the right. Okay. Now, linking into interest expense and interest income. Let's go to the income statement. Here, interest expense, we're going to pull in from the debt schedule, 31160.3. A little higher because our rates are a little higher. Believe it or not, I put a template in of our rates to be 5%. And actually, the rates seem to be even lower than that. But again, I don't want to go into tweaking the percentages just yet. And then interest income. I know this confuses a lot of people, but remember, we pull in interest income as a negative. Why? Because remember when we first built the income statement about 17 weeks ago now, we had said the layout of the income statement is every expense is in positive numbers, except for revenue. Every expense is in positive numbers. Any income is negative because you're subtracting down. So if there's a positive number in here, it would have increased our expense. No, interest income is income. So we want to pull this in as negative from the debt schedule. 906. Okay. Here we go. Now, very important, circular references. So we're going to continue to pull this in. We have created a circular reference. I started talking about this at the end of the last class. This is an intentional circular reference. A circular reference is the circular reference here is based on the fact, because we've linked in interest expense and interest income, is because the interest expense and interest income impacts our net income. If we were to increase our interest expense, our net income is going to go down. If our net income goes down, way down here, then our net income drives cash flow. Our cash flow goes down. If our cash flow goes down, right down here. The cash on our balance sheet changes. If our cash on our balance sheet changes, that impacts the interest income calculation, and so on. It cycles through. So what I want to do is Excel popped up an error message saying you have a circular reference. I want to tell Excel, no, it is intentional. I want my circular reference. So once you start building a complete model, you're going to want to tell Excel, okay, that you have a known circular reference. So what you want to do is you want to go to data. Okay. Hang on a minute. Why are my windows popping up and down? So this is tricky because it depends on the Excel version that you have, and it depends on if you're on if you have an Apple or what year Excel you have. But for mine, if you go to File, Options, okay, Formulas, and you can always just go to your help bar and do circular references, and it'll tell you how to navigate it. But what we're looking for, everybody has, when you get to the right box, everybody has calculation options. You want to enable your iterative calculations. You're basically telling Excel, I have a circular reference, iterate 100 times, go through that circular reference 100 times. Hit OK. It's going to iterate. What are the iterations again? Let me explain it. On your income statement, your interest expense and interest income are being impacted. That affects your net income. Your net income affects your cash on your cash flow. Your cash goes all the way to your debt schedule and affects your interest income. And if you're raising or paying down debt, your interest expense. That is a circular reference. Very important to have that circular reference in your model. I have a whole YouTube on circular references, a whole YouTube video if you want to look at that. Once this is in, okay, the model is complete. I'm just trying to the income statement is complete. Now in the cash flow, the missing piece here are our issuances and retirements need to link in to the cash flow statement. Each one. So short-term debt, need to link in from the debt schedule. So short-term debt borrowings need to link in from the issuances and retirements from the debt schedule. Issuances, automatic and mandatory. Okay. Our long-term debt needs to link in from our long-term debt issuances and retirements. I know it's zero, but it'll have meaning once we utilize the model. Finance leases. These are the leases. And finally, the repayments of the finance obligations. Short-term, mandatory, non-mandatory. Link those to the right. And now we have a fully linked model, because once we raise debt, it should impact the balance sheet. Okay, let's prove it. Let's say I were to say long-term lease liabilities, I'm going to pay, I got $40 billion in debt. I want to pay down all my long-term lease liabilities. Or let's say 30 billion of it. Okay, I want to pay down, so I'm going to put right in my mandatory issuances, negative 30, 1, 2, 3. Debt goes down. I want to prove that I still have yes. Still links through. My issuances go down. My interest expense drops significantly. This should reduce the balance on my balance sheet. Does it? Yeah, went down by 30 billion. My cash flow statement should portray, there it goes, 30 billion pay down. And look, my cash is down by 30 billion, but my cash flow before debt pay down is still 41 because it does not include that 30 billion. The income statement should show a reduction in interest expense. And herein lies the circular reference, right? I've paid down debt. My interest expense has gone down. If my interest expense goes down, my net income's a little bit higher. And I have less interest expense. If my net income is a little bit higher, then my cash flow statement's a little bit higher. Net income drives cash flow. If my cash is a little bit higher, I have a little bit more cash. How do we prove it? I'll show you. I'm going to put this to 0. Okay. I'm going to come up here. I have 46770.8. Or more importantly, I have 40678 in cash I can use to pay down debt. All right, let's stick with this. Okay, 46770.8. When I pay down $30 billion, look at that. You should go up by $1 billion. So I pay down debt and I have more cash now? No, you pay down debt, you have more cash before that pay down. Why? Because of the interest expense savings. Big investment banking interview question. How do you walk through this circular reference? How does this work? Because you've paid down debt. Look what's happening again. I'm going to do it again. It's 46770.8. Negative 30. What's going to happen is basically your interest expense is going to go down. There it goes, down by 500 million. Goes to the income statement. You have less expense, more net income. You have more cash. Very important. This is the key to how all the models link together. And important investment banking interview question, right? If you were to raise debt in a model, walk me through the changes in the income statement, cash statement, balance sheet. Well, if I were to raise debt, I go to the debt schedule. I'll raise $10 billion. Right? My interest expense is going to go up. My interest expense will go to the income statement. That will reduce my net income. That'll reduce my cash, right? That'll also go back to the debt schedule. In addition, my issuances will link into the cash flow statement, right? And will flow into the balance sheet. My balance sheet debt will go up. That's how you walk through that. So the next phase of the model is fully linked, completely done, right? With the exception of honing in on assumptions, digging in on the interest rates here. Are these interest rates accurate? And I'll tell you right now, they're not, because we just threw in some numbers. They're close. There are some things in here that we kind of highlighted to say, well, we kind of threw out some random assumptions. Now let's step back and analyze the model. And this is where I said, well, we started building this model last year, literally. They've updated their numbers. Their stories changed post the pandemic. It makes more sense to analyze this model once we have their latest numbers. So at this point, my recommendation is I'm going to update the model, and then we can manipulate the model. But the next phase of the course is running scenarios. How do you run a professional debt raise scenario or a debt pay down scenario? How do you value this company? Right? That's the valuation portion of the course. But what I strongly recommend is to have you go to Amazon's website and take a look at, understand this final model completely. Take a look at the model. I'm going to send you this one, and I'm going to send you the updated. I still might make further tweaks to the updated, but I'm going to send you what I have to date. I'm going to send you that and take a look at them and compare them to the numbers. So if you have any questions, please let me know. Sorry again about last week, but this is basically what we had gone through, and I've gone a little further. We've completed the model. And what I'm going to do is I want to think about what the right format would be for the valuation part of the course. I might just post videos and upload them, or if you guys have a recommended alternative as a better time that works, where it's worth being live, then great. Just shoot me an email. In the meantime, I'm going to send you these models, and we'll talk about the next phase of the course. Thank you, guys. Take care.